Bhaven Ondhia, Managing Director of First Financial Foundations. Welcome to the show.
Thank you, Raj. Nice to be here.
Let's start with the number one question that I've been thinking since I moved back to the UK. How the hell did you finance guys become overnight rock stars?
So I think that's a very good question. I think it's always been there, but I think with social media, people getting a little bit more creative and wanting to know a lot more about their own finances, they're delving into it that much more, wanting to find out that much more. I mean, going back 15, 20 years, you had the accidental property investor where they inherited a property or as a side hustle, they purchased a buy-to-let, etc. But it's now actually become a business and a lot of people have made money out of it. And before you know it, there's so many doing it. And rather than buying one property here or there, they're buying multiple properties. You've also got to remember that a few years ago, interest rates were quite low and that attracted a lot of people. So that bandwagon's been going for a while and long may it continue.
You think there's a kind of a call to arms now that everyone's going to be a lot more proactive about their finances and their protection?
I think so. We're certainly seeing that. Again, I go back to the information out there. There's so much people want to do and people are becoming more and more creative as well in how they invest. How can I make an additional route to second income, etc. And what's happened is, let me give you the example. A lot of people started off, for example, in the buy-to-let market. They've then moved on to the commercial side. Then they've gone on to HMOs, houses of multiple occupation, student let, the rise of holiday lets, Airbnb. But it's all property related. So they're still going into property. Property will still need financing, but they're finding new creative ways to continue that journey and put money into bricks and mortar.
Right. And what would you say was the biggest black swan event then of the last 20 years? Are we talking 2008 Great Financial Crisis, Brexit around 2016, or COVID 2020? Like, what shifted the ground the most?
So I think each one did their bit, but I think it really started when the interest rates were low. So we're going back 15 years or so. That's when it really hits people. There's so much I can do here, so much more I can make in terms of an additional income. They see a lot of people doing it, friends, family, other investors, etc. And it became a thing. It became a go-to place. You've also probably seen that a lot of funds became just property funds. And what we found with low interest rates, property prices were also rising. So people were taking out mortgages on a buy-to-let, and a couple of years later, they had so much more equity. Oh, this is easy, let's do another one. Then they hear more about it, let's do another one. So I think, all of those that you've mentioned had a factor, but I think the low interest rates is probably the biggest one that turned people onto these sort of investments.
And you specialize in mortgages and income protection. We're going to deep dive on each one of those in a moment, because I think our listeners really need to get up on that. Starting off with mortgages, what are the most obvious blind spots? Like, when people talk to me about content, I know certain things about social media, cameras, things of that nature that the average person walking down the street's not going to know until they hire a specialist. What's the first thing that you always pick up on where it's like, somebody should really know that, and it's kind of like a forever blind spot for people?
It's coming to see us too late. We find that a lot of clients have put an offer in and then they come and see us. I need a mortgage, my offer's been accepted. What we would prefer is, of course, come and see us before you're going to put that offer in, because if there are going to be any challenges, obstacles in the way, or circumstances that they're not aware of, we can start working on it straight away.
There's the downside of that, though, that if you put an offer in on a property that you're somewhat legally bound, and then kind of praying that you get your mortgage in place is a bad strategy. Really, it should be that you go talk to a mortgage advisor first, and that's where you kind of figure out affordability.
Exactly.
Right.
And it's not just about affordability. Sometimes clients are not aware that there's a blip on their credit rating. Sometimes clients are not aware the fact that they've just taken out a personal loan is actually going to hinder their affordability going forward. Not always the case, but those sort of things do matter and can play a part. So with that example, it could affect whether you can borrow the full amount you want, or it's going to drop a little bit to what you do need. And that means, of course, having a slightly higher deposit, a different interest rate. So all these things, that sometimes you don't think about. The other area that a lot of clients miss is the additional costs that go with purchasing a property, the broker fees, the legal fees, the arrangement fees, the moving costs, stamp duty. Sometimes these are missed. You've got to factor these in. Too often it's, I've got the deposit, I know the blanket, how much I can borrow, this times my multiple income. That's just a template, but there's a lot of other factors, a lot of other formulas that lenders use to decide what your borrowing capacity is.
So have you ever stopped anybody from like standing in dog dirt on the street and being like, hey, you're about to apply for this personal loan. You're also talking to me about a mortgage. Chill out on the loan for now. Let's get the mortgage through and then we can figure the loan out later on, because effectively they'd have like two parallel credit applications happening at the same time.
Yeah.
And the smaller one could hinder the larger one.
Absolutely. So we've had these sensitive conversations, and only rightly so. And that's why I go back to speak to an independent advisor first, so you know your scope. Mm-hmm. Anything in the background, he, she, they will be able to work out for you, so that you are armed fully and confident that this will go through, because I've done my homework first. So what's that phrase? You don't plan to fail, you fail to plan.
Yeah, it makes a lot of sense. I've applied for a mortgage once before, and one of the things that I was asking myself as a first-time novice, this was maybe 15 years ago, is now the right time to get a mortgage? You've been in this game for 30 years. In general terms, is now the right time, or is there such a thing as the right time?
Yeah, again, this is a question that I get asked quite a lot. When's the right time? Well, the right time is when you're ready, actually. Sometimes you may not be ready. And what I mean by that is, look, interest rates will go up and down. Property prices will go up and down. But property is generally seen as a long-term investment. So you could buy a property today at a great rate, but 5 years later, the interest rates are high, property values aren't going up, but you've already committed this 5 years ago. The other side is as well, you might be fortunate to go in at a low point. So there isn't really an exact science to this, but if it feels right and you are ready, the affordability is there, my say is go for it. Let's do it. Just move forward on it.
Right. And if you've got, let's say, a 25-year mortgage, and that's broken down into roughly 5-year commitments, whether it be fixed or variable, but you commit. From my understanding and through talking to people in the industry, really the best time that you can make an adjustment is towards the end of one mortgage cycle and the beginning of another. So, for example, there's a lot of folks in 2026 that are coming out of an extremely low interest fixed rate mortgage that will be going into a slightly higher interest one, which will mean more cash leaving their direct debit to pay for their home via a mortgage. At that time, you can choose to pay off more of the capital, right? So that when you go into that higher interest new contract, that yes, you're going to pay higher interest. There's pretty much nothing we can do about that, but you can be quite thoughtful as to how many pounds leave your account each month by paying down some of the capital. Is that strategy wise and something that people should be following? And what are the other strategies around that you talk about?
Absolutely. And we have this conversation with virtually every client. The mortgage itself is a long-term commitment, but it can be broken down into 2, 3, 5-year segments. And we will make the best of it every 2, 3, 5 years. Now, whether we commit to a 5-year cycle or a 2-year cycle is a conversation at the time, depending on the market and their circumstances, interest rates, property prices, etc. But we educate our clients. We give our clients a realistic goal in terms of what to expect. We don't have a crystal ball, but we have an idea. And this conversation we have on a regular basis. So when is the right time? You're right. It's probably just before the end of a cycle. So if you're on a 5-year cycle, we will start speaking to our clients after 4.5 years, 4 years and 7 months. Get a feel of what the market is. Have a conversation with them. We will then note that this client is a risk taker, averse, he's got other plans in the background, etc. So then we can actually work out what's the best strategy for the next cycle. And I've got clients that have gone from 2 years to 5 years, 5 years to 2 years, even those who have stayed on tracker for a while. And during the low interest rates, why would you move out of a tracker? It was low and it stayed low. So as and when the cycle ends, You have that conversation 5-6 months ahead, and then take appropriate action depending on the circumstances.
So imagine then that I'm a first-time person who's about to get a mortgage, like residential mortgage. Okay, maybe I'm solo, a bachelor. Maybe I'm part of a couple, like double income, no kids, and I'm just about to go into the market. How should I set my mind up in terms of like that first mortgage?
Yeah, so good question. So first and foremost, you may be in that property for up to 25 years typically, but also there are chances that you will move a number of times. So you've got to think of this commitment, this mortgage, as a number of commitments spread over 2 to 5 years multiple times. So for example, over a 25-year mortgage, it could be 5 lots of 5. Over 25 years, it could be 12 lots of 2.
So even if I know that I'm buying my forever home, which is unusual for somebody in their late 20s, early 30s, even if you plan to live in that home forever, you're still going to have to redo that mortgage every 2 to 5 years anyway. So don't think about it as like a single mortgage forever. You kind of get 4 or 5 more goes at it at least if you're doing 5-year cycles, but maybe even up to 12 goes at it if you keep changing every 2 years. Is that something that you think most people don't know?
Yeah, it sometimes gets forgotten. And what you need to realize is your circumstances could also change. You've touched on it that this could be my forever home. Very seldom is it your forever home. Your circumstances change. You're a bachelor at the moment, a single person. You get promoted, you want to live in a different area, you want to live in a bigger house, you might have moved from a flat to a different type of property. So these factors will probably change how you go about your mortgage as time goes on. But as the first one goes, you've got to think about it as an initial commitment of, for argument's sake, a 2 to 5 year commitment over a 25-year commitment. And that will decide whether we go short-term straight away or long-term. Each case is different. So given your circumstances, if you're promoted in a couple of years, you might say, hell, I'm going to move here now. I'm doing quite well. What do I do now? Well, that's where we come into play and assist you going forward on those.
Okay, that's good to know. Now, one of the most common things that you hear when it comes to mortgages is that it's always good to have a mortgage. It's the cheapest kind of debt. It's the best kind of debt. What do people mean when they say that? And is there any truth in it?
Yeah, there is some truth in this. And what do people mean by that? What they're saying is, I think you have to look at the bigger picture. A person having that debt also means they have bricks and mortar. They have a property. They have a roof over their head. They're going to grow in that. They are also expecting the value of that property, that asset, to grow with them. So whilst today you might have gone in with a 50% or half of it being borrowed, at the other end, if you keep up the repayments, etc., you're going to have an asset that's going to be worth so much more on the back of you having that debt. You would have paid that debt off, typically, and then have an asset worth so much more without any debt. And of course, at that point, you could downsize and do so many other things. So it's not necessarily a bad debt.
Now, mortgages have become super mainstream now and everybody wants to know about them. And as you've mentioned, you've got a lot busier in the last couple of years. If you were to explain to people over this podcast right now, hey, listen, we're going to meet in a week or two's time. You've got an appointment with me, a Zoom or in-person coffee, whatever it may be. But in the 1 to 2 weeks prior to us meeting, here's a couple of things that I need you to think about to prepare you for the best meeting you can have with me as an independent mortgage advisor or anybody else in the industry. What are some of the things that people need to think about before they come and meet you?
First and foremost, are you ready? What I mean by are you ready is your background clear and concise? Are you aware of your credit report, your history? If that's not black and white, or I'm not able to see this, it could jeopardize how we go. So it's always important to know what your background is and what your commitments are as we speak today. And knowing that this is going to be a long-term commitment. Is your job safe? Self-employed? Have you been self-employed for an X number of years that we can prove your income? So whilst finance might be just one of the areas, you need to know a lot about your existing circumstances as it stands, because you can't take away that I've got, for example, 2 kids in the background that are going to go to private school. That's going to hinder your affordability and how you move forward with this. You might have a commitment coming up. You might have some inheritance coming up. You don't know. So these things are important to know up front. So I would want to know from you, what are your present circumstances and what is expected in the coming years, so that any commitment that you are involved in with a mortgage, you're going in transparent, knowing this is going to be for me, this is right for me, etc. The unknown is where it hits us the most.
So it's interesting you say that, because whilst it's morbid, it is also responsible to think, hey, over the 25 years that I have this mortgage, it's likely over the 25 years that one of my parents or both of them will pass, and I'll experience an inheritance event, which will then introduce cash flow into my world, which I can then leverage either on other properties. How will that affect my current mortgage? I can pay off my current mortgage. How will that affect my affordability for other investments in the future? So it's really about zooming out and going super big picture, right?
Absolutely. You've got to remember that this kind of commitment is long term, and circumstances can change one day to the next. 25 years is a long time. 25. I say 25 because that's a typical mortgage, but it could be a 35-year mortgage. The youngsters are starting their mortgages in their 20s. Mortgages can go up to the age of 70, 80 even. So think about it. That could be a 40, 45-year. Things are going to change. You've got to be aware that my circumstances will change within that. And if they do, how am I going to react to this?
Good. And whilst we're talking long term, beautiful segue, by the way, let's talk about the other kind of skill set that you have with your other arm, which is protection. Now, whereas mortgages have become mainstream, as we mentioned at the top of the show, insurance and thinking about insurance and life cover and life protection, I feel like that's still kind of in the closet finance subject, because as you rightly said, it doesn't necessarily mean that when you buy it, you're now living in different bricks and mortar. It doesn't affect your residence. So there's very little tangible about it other than, I guess, peace of mind. So give me a 101 onto like life insurance, life cover, protection. What are the high level categories?
Yeah. So again, how can I protect myself? The client has to realize, the client has to realize that I'm taking on a commitment of X £100,000. What happens if whatever's paying for that on a monthly basis is no longer there to pay for it? What are you going to do? Let me ask you the question. You've got a £2,000 a month mortgage, £3,000 a month. If that income were to stop, is your mortgage going to stop?
No.
No, that's going to continue. What are you going to do to make sure that that mortgage keeps getting paid? You don't want anybody knocking on your door to say the mortgage hasn't been paid this month. And you can protect yourself in these things. So there's 3 areas that you should consider when taking out a mortgage. And that would be your straightforward life cover. If something were to happen to you, how would you want that property to be passed on? Mortgage free or cleared? So give the example of a couple. The mortgage is based on both of you. The income generated by 2 of you is what produced that mortgage amount. Now, if one of you is no longer there, the other person may not be able to afford that mortgage anymore. But a protection plan in place can assist you here. Now, that could be paying off the mortgage in its entirety. You've got to remember that we're not looking at replacing the individual. That circumstance, as sad as it may be, is not something we can assist you with. That's an emotional thing. However, financially, we're looking to make sure that you're no worse off.
So you made the point there about long term, which links nicely into the other skill set you've got, which is life insurance, critical cover, making sure that these debts that you sign up for, mortgage being one of them, are covered in the event that something goes wrong. What are the high level pockets of insurance that you should be thinking about? Is it even called insurance? I guess it's protection, right?
We call it protection.
Okay.
And I think the area that you're talking about here is what happens if I'm no longer able to pay that because something's happened to me.
Yeah.
So, yes, it is life assurance, but there is a variety of protection, life assurance being one of them.
Yeah.
In simple terms, why is it good to have life assurance or protection in this instance? The mortgage is taken out typically on, say, 2 people, and it's based on the affordability of 2 people. Now, if one of you are no longer there, can the other one afford to maintain this on one income? A lot of the time, they are not. Secondly, what would you want to happen if that income stopped because the other person is no longer there?
Yeah, and also whilst grieving, or if they're critically ill, whilst caring for that person, like it's not as if he's going to go back to work and continue to get bonuses, right? It gets real when it goes wrong.
Exactly. So the emotional part is difficult for everyone.
Yeah.
But the financial part can be taken care of. So when I speak to you, what we're looking at is how can you protect yourself in that circumstance? So there's 3 areas of protection. The first one being the life cover that I've just mentioned. What would you want to happen to the outstanding debt that you have should one or the other pass? Ideally, you don't want that debt. That can be catered for. So upon death, sad as it may be, the financial aspect can be removed. So if your mortgage is 200,000, 500,000 or 1 million, we can cover that so the financial debt doesn't continue. The other area that a lot of people miss is what happens if I'm no longer able to work. I'm alive, but I can't work because of accident, injury, circumstances that mean that I can't work due to long-term illness, a disease, etc. At the moment, if you don't pay your mortgage, you're going to have the lender coming at you to say, where's my payment, etc. You can actually cater for this. It's what we call income protection. As the name suggests, it's there to protect your income. If you are not able to have that income because of your circumstances, you're ill, you're injured, accident, disease, etc., that mortgage still needs to be paid. Those bills don't go away. You've got to remember that. And it's not just your mortgage, your council tax, your car, your utility bills, all those, your travel costs, they don't stop. Your mortgage doesn't stop. You need to protect that. And that can be done via income protection. A lot of companies offer income protection, but for the self-employed, where do they go? You've got to remember, if you're self-employed, a lot of the time, if you're not earning, if you're not out there working, there's going to be no income coming in. Then what?
And the hottest subject right now online seems to be the fact that most people that are in this world are going around saying like, hey, dummy, you can charge this to your company.
Exactly.
Like a lot of people don't realize that. I've only realized that since I started hanging out with you. I'm like, you know, as business owners, we're always trying to optimize our profits to make sure that we are as tax efficient as possible. And I think when you think about life and critical illness cover, you're like, well, that's another thing that comes out of my pocket post income tax or post dividend tax. But it's not.
No. So for the self-employed, as you touched on there, it is a legitimate relief that they can have as an income protection if you're self-employed. We want to educate people on this. It's there. You can do this. It's a legitimate expense. And you touched on another thing there, which is critical illness. There's a few stats I can share with you on this. I remember when I started in this industry in the 90s, early 90s, it was 1 in 4 would get cancer at some stage. I read a stat a few weeks ago that said 1 in 3 in the year 2005, 1 in 3 could potentially get cancer. I'm now hearing that by 2035, that figure is going to be 1 in 2. So you're giving yourself, a typical person, a 50% chance of having cancer at some point in your life. Now, those stats are damning. If you think about it, a 50% chance. 50% chance. If you knew that there was a 50% chance of you having a road accident, I'm sure you'd make sure that your car is insured. I think you need to take care of yourself first. And this is what critical illness does.
There's a version for businesses as well, right? Like if you're in a partnership with somebody and they pass away, rather than that being passed on to their estate, which could be other people in their world, spouse, kids, things of that nature, that are now like the equivalent owners of the business that your partner was before they passed away. Like that sounds to me like something that needs to be protected against as well. Absolutely.
What you're talking about there is shareholder protection or key person protection, a legitimate expense for the self-employed. In simple terms, what it means is, should something happen to you, and I'll give you the example, you've got 2 directors, 2 partners, 2 brothers, 2 friends, whatever it might be, 50-50, standard situation, very common out there. How are you protecting yourself? Well, if something were to happen to that one partner, your business levels could go down because he was a key person. What the standard way is, a life cover plan that will cover the loss for that person not being there. A lot of the time, those funds would go to a spouse or somebody in the background, a family member, etc. And they can join the business. You might not want that person to join the business. You might want to go a different angle, a different way. Well, you then have that option to do what you want with those funds. And that's key person or shareholder protection. Sometimes the family member that the money goes to isn't actually interested in the business. You may not want that person in that business. And you can cater for that in a legitimate way, tax efficient way, should something like that happen. And the point to remember on this, that it is a life assurance, not an income protection. It's a lump sum payment rather than a regular monthly payment.
Got it. Okay, we've got a good start there. We are going to have another conversation about this, because I feel like, especially someone as myself who's a UK company director, family person, I'm like, boy, there's a lot I've not thought about. And the reason why I wanted to put this podcast out today is because I've been in the UK now for quite a while. And these aren't conversations that I was having with a lot of people in Dubai, and I feel like here, whilst the UK is definitely going through its own challenges, it's definitely a mature market when it comes to like financial and insurance products. And even if you do ride without a seatbelt, through your 20s and 30s and don't think about some of these policies, it's something that needs to be addressed now. So Bhaven Ondhia, Managing Director of First Financial Foundations, thanks for joining me on the show today. If anybody wants to get in contact with you, what's the best way to reach out to you?
So the easiest way is either call the office or contact me via email. My email address is Bhaven, Bhaven, at 1stff.co.uk. Bhaven at firstff.co.uk.
All right, I appreciate you, man. Thank you so much for taking the time.
Thank you.